Hello, Uncle Jim here. Today I want to share with you how you can earn a really good income stream, not just in retirement, but currently. It's given me the ability to become financially independent. And this is through selling options as well as earning really good dividends. I'm also going to share with you at the end of this video my trades for the month of March. It's become my best month ever. So stay tuned. I think you're going to enjoy what I have for you. Okay, let's go ahead and jump into the main part of the video. I do want to give a quick market update. For those of you who have watched my videos before, I typically like to do this in most of my videos. Just kind of give a market feel or where I feel like the market's going. I do believe the Fed is done raising rates. They may even lower them later in the year. They become much more dovish. That doesn't mean that we're kind of in the clear. I do think we potentially may have a bear market bounce. And I do think we're going to continue with a lot of volatility. And you'll see at the end of the video, I've sold 20 options this month, and half were, or more than half were covered calls. So, and we'll talk about that more at the end of the video when I go over my trades for the month. Doesn't mean I'm done for the month. I may do one or two more trades, but probably not, because I've got a really busy day today and I've got a really busy day tomorrow. So probably won't do any more trades. So again, I've split 50-50, or actually a little bit higher of a percentage with covered calls versus selling puts. Now, I do think we still have some issues to get over related to the banking industry. I do think the banks are still way oversold. Schwab has come back some, and I really still think Schwab's a really good investment. There's been a lot of fear mongering out there. And Truist, the same thing. It's way undervalued, and I do think it'll come back. Now, it may take a while. It may take a year or two, but I'm willing to own both those companies, and I'm willing to take the time to let them recover. So, I think it's still kind of a mixed bag. I do think there are some good things that are occurring. So I'm a little bit more bullish than I was before. I'm still a bit bearish, and I think going forward with my trades, I'm probably going to take a little less risk with my covered calls, just because I don't want things to get assigned. If we do end up having a significant bounce, I don't want to lose some of the shares, because my dividends, for those of you who follow my channel, my goal is to be getting about $2,000 a month in dividends. I'm at around $1,850, and I think I can increase that and make that $2,000 a month by the end of the year. So I'm not going to take quite as much risk as I have been with covered calls. And I'm still going to try to look at a 15 delta for puts. I still think we're going to have some, topsy-turvy times. I don't think we're going to hit another low. I still believe last October was the low, but we may test it a couple times. So that being said, let's jump into the main part of the video. And as always, please hit that like button. Please subscribe. I'm a small channel. I want to get the word out that this is another way for people to earn some really good income, especially in retirement, or to become financially independent. I'm 57. I'm pretty much financially independent. I'm still working part-time, more like 15 hours a week. And between those things, selling calls and puts and earning dividends and making some income, I'm pretty much financially independent. And I don't really ever plan to truly retire. To me, I like what I'm doing. I'm probably going to do less software development and a bit more more related to the channel and teaching people. And I am going to add more bells and whistles for my patrons. I'm currently working on a new Google worksheet that I'm going to use as my wish list. And hopefully I'll have that sometime in early to mid-April. So if you're in either one of my Patreon memberships, just be aware that is coming. Now, jumping into the main points, with my retirement planning, I've always, what's key for me, and this was well before I made a lot of money selling calls and puts, I've always liked dividends. I've always been an income investor. I've always wanted to, have my portfolio work for me versus me work for it. And that's worked out quite well. And part of it is because overall I've pick good investments. I pick good value investments, companies that make good money, companies that pay dividends and that grow dividends. And that's allowed me to, keep a lot of these companies for my entire life. A lot of what I have, I did inherit, and I plan to pass it to my son and just live off the dividends and maybe selling a little bit here and there just to keep my portfolio balanced. But what I found is having these value companies like Coca-Cola, Procter and Gamble, Cisco, just to name a few, they increase their dividends pretty much every year. And then, when you're 10 years down the road, some of those dividends have become quite significant, and you can earn a lot of really good dividend income that way. And then with options, like I said in my journey over the last couple of years, I had been selling covered calls from, I believe back since 2010, 2011. And just, I had no idea what I was doing. So now having a better understanding of what I'm doing and then kind of changing it over time, I make changes to become a better option seller. Part of that is taking less risk, figuring out what I need. And it's worked out quite well. And then also with my part-time work stuff, again, with software consulting, I do like it. And it actually keeps my mind busy. I really, like doing software work. I am getting a little bit tired. I did mention earlier I am getting a little bit tired of it, but I'm almost done. I'm working on an MVP, a minimum viable product. And once that's out, then it'll be mostly a support situation for that client. And my guess is that'll keep going into the future, probably for the next several years. So those three things have been able to bring in quite a bit of income. And then I have other ways to earn income. So finding, ways to bring in additional income in different avenues has worked out quite nicely. So you can really, build up different avenues of bringing in income or income streams, and that really helps you in retirement when you have more and more. Now, also what's really important too, especially planning for retirement or planning to be financially independent, you really need to know what you need on a monthly basis. I did a prior video. I'll add a link to it up above and maybe below too, where I talk a little bit more about how I budget. I just recently updated my budget. I did have to increase as my taxes went up, property taxes went up, my federal taxes, I believe, also went up. I also had almost all my types of insurance that I have also went up. So I was averaging about $4,500 a month. I'm more like $5,000 to $5,200 a month currently. And that's really important. If you don't have a budget, I encourage you to look at setting up a budget, figure out how to do it. I keep it simple. I just use spreadsheets. And again, if you're a patron, I provide those spreadsheets. If you see it in the video and you're a patron, just ask. It's worked out quite well for me, especially with determining what I need on a monthly basis. Now, my budgets are a little bit different. They also incorporate what I call the 4% rule. And if you're not familiar with the 4% rule, it's just a paradigm that was put together related to, and there were studies done on it. You could live off about 4% of your portfolio in any year, and it would last for over 30 years, which, most of my family or most of the men in my family live into their early 80s, and that's what I'm figuring I'll probably live. So I would need it for about 30 years. But with all these other income streams and, never truly retiring, my dad's 83 and he's still working. He's got his own business. So I see me continuing to work and I have all these other incomes. So I don't necessarily need a 4% to be pulled out of my account, but I may need 1 or 2%. So my budget also has, connections to a calculator and how I calculate how much I need and would need. So my budget's a little bit different than most, but it works well for me. But the main emphasis, if you need a certain amount every month, and it's a whole lot easier to determine not just, how you want to plan your retirement, how much money you might need, but also how to determine, can you use a 2% rule? Can you use a 3% rule or a 4% rule? And some people even say as high as a 5% rule. So something to keep in mind. And then, another important thing is depending on your risk level, I'm selling calls and selling puts, and I'm trying to grow my portfolio, but you don't necessarily have to do all the things I'm doing. If you're following this channel, you may feel better about just selling covered calls. So you may say, well, I like to build my portfolio. I have a good portfolio. I'm earning good dividends. I just want to stay really safe, and all I want to do is just sell covered calls. And that's something you could do. And I think covered calls are probably one of the safest strategies. Now, if you want to get more involved, you can then sell puts. You could do the wheel, but you can kind of pick and choose. You don't necessarily have to do everything I do. Once you figure out what you need on a monthly basis, then you can kind of, work your income from selling calls and puts to best fit your needs. You don't necessarily have to, follow what I'm doing. You can kind of take it, rearrange it, and make it work for you. And then one thing I've also seen is I've noticed a lot of people have had a lot of fear and overthinking. It's with what happened with the bank crisis. I really saw a lot of fear. A lot of people kind of saying, "Well, I'm going to move out of the market. I'm not going to continue to invest because this isn't working out and it's too risky." And I think that you have to be really careful, because really when the fear is occurring in the market is really the best time to buy. And that's what I've been doing. So I do have some puts that are in the money, especially Schwab. I think I have a put at around 70, and I think Schwab is around 55. But I sold another put, or two more puts on Schwab at even lower prices, and I believe they're currently outside the money or right at the money. And same thing with Truist. And what I was able to sell with Truist was one of my most profitable trades, and it's quite far outside the money. So I encourage you, it's almost like dollar cost averaging. You need to stay in the market. You need to continue to be working your plan. You need to not be overwhelmed with fear. I have also noticed that, try not to take too much risk off the bat. I started with one contract, with any trade. Then I went to two, but I've never done what a lot of the other traders have done. I've seen traders who have done 5 contracts, 10 contracts, 20 contracts, and I stick to a real basic plan. So that's another way you can change what I'm doing and make it work better for you. Is if you are just getting started, I encourage you to do one contract only until you get used to it. So sell one, say you have 600 shares in a specific stock like Cisco. And again, if you're not sure what a covered call is, it's a contract where people will pay you money to buy your shares. So they'll pay you a certain amount of premium for the opportunity to buy your shares at a certain price. So if you own 600 shares, you could sell one of those contracts, kind of get used to covered calls. Then you could go up to 2, 3, 4 and increase the risk. And the same thing with puts. You don't necessarily have to start with, like I do, 2 contracts. One contract may be safer for you. And I actually encourage you to start with one. If you go back and you look at my early days in my videos, I started with 1 and then moved to 2. And I haven't gone past 2. On occasion I will, if it's something that's fairly inexpensive. I did that with Lumen. But, Lumen it's one of my dogs. It's one that I'm keeping probably to offset some of my gains in other places, but it may bounce back. It went from, I think, 11 or 12 down to 250. I think it's 250. At one point, it did get close to $3 in the last couple of days. But I did more contracts with those. I also did more contracts with Ford. And again, when they're inexpensive, Ford, I think, has been trading between $10 and $15. So I'll do more trades with that. But for companies like Cisco, and especially a company like Apple, I have done 2 contracts with Apple, which is I should probably only do 1. And I encourage you, if you're going to do in a real expensive stock, start with 1 contract. So you can really kind of, determine what's best for you and kind of, come up with the best strategy for you and what you need. So with that being said, let's actually jump into the next part of the video. I want to share with you how I did this month. It's my best month ever. I'm just shy of $4,500 for the month. I believe last Last 2 months I did in the high threes, like 3,800 one month and just shy of 4,000 another. So I'm averaging over 4,000 on a monthly basis. And in my mind, I'm not taking too much risk. So let's jump into that. I'm not going to go into detail on every trade. In some of the previous videos, I went over some of the trades. I'm just going to kind of show you how it all broke down. I ended up doing 20 trades, and you'll have an idea of looking at how profitable they are or not. And then also how many were, covered calls, how many were vertical put credit spreads. And one thing which is interesting, I did all vertical put credit spreads. I didn't do any cash secured puts in March. So let's jump into that next part of this video, and I'll share with you the trades that I did this month. Okay, here's my monthly worksheet for March. What I did is I took all my planning worksheets for March and pulled the trades that I made and put them into this spreadsheet. And there were a total of 20 trades, and I've sorted them by profitability. So the ones at the bottom are the most profitable. And it just happened that the vertical put credit spreads were the most profitable. So they're at the very bottom. And then all the covered calls, you can see here's all the covered calls. And there were 12 of them. So of the 20 trades I did, 12 were covered calls, 8 were vertical put credit spreads. Also, 10 were new and 10 were rolled. So nice breakdown of those. I'm not going to, like I said earlier, I'm not going to go into a lot of detail. So the first few that I have here are all Coca-Cola. So I rolled 4 contracts, and these were existing contracts, and I rolled them farther out and picked up some pretty good premium. So they were 4 contracts. I made 218, rolled them from 616 to 1215, and I rolled them up just slightly from 65 to 67.50. At the current price, Coca-Cola was at 59. So, and then for the other ones, Coke was new. I did a new cover call at 70, expiring on 6/21/24, and brought in $298. So not bad. And then finally, I did actually 4 Coca-Cola. So I had another roll of Coca-Cola. Some that were expiring on 1/19/24. So this one's a little different. I actually rolled them down from 75 to 67.50 and brought in quite a bit of premium. They were very, very profitable. Now that you can see the yearly return for these is pretty low, and it's because I'm using the full price of Coca-Cola. I'm not using my cost basis, which would make them significantly higher, but I kind of want to keep it the way I've been doing it from day one, just so you can see compared to if I sold those, I would bring that much cash. So I do think putting the full value, not the cost basis, for me at least, is a better way for me to go in comparing these trades. I did some covered calls in ARC and did quite well with those. Did 48. Yeah, the short strike was 48. I rolled it out 3 more months, upped it to 49. Again, these were very profitable, and I brought in almost $400 or 305, and that equated to like right around a 4% dividend. So did well with those. I also did some covered calls in IJR, another ETF. This was a roll. I rolled the covered call, and I lowered it too. I found that during the bear market, some of these became very profitable, and I did a roll, which in fact is closing and then opening another position, and that worked out quite well. It's brought in 332. Its ROI was just right at 4%, so that worked out well. Here's another Coca-Cola, another new one. I did it for a little bit less with a 29 Delta expiring in July, and brought in another $212. So I currently closed, or not currently, I had closed a bunch of Coca-Cola covered calls. So I opened a few more just to bring in a little bit extra income. And that was like a 4.4% yearly return. SDY, another ETF. This was another roll, same kind of scenario. I lowered it from 135 to 132, went out another 3 months, brought in 287, and more than doubled the dividend at 5.21 yearly return. So again, did quite well with it. GLW was the next one. Corning. I rolled another 140. I lowered it to 38. Again, because it was very profitable, I brought in another almost $140, and it was a ROI of 5%. Then Cisco, and again, Cisco, I've done lots and lots of trades with it. Definitely have done the wheel with Cisco, and now I'm selling covered calls. A new covered call, 5250, 28 Delta, and it currently was at 4850. I brought in, what is that, 194? Is that 194? Yeah, 194. And it was, I believe, just shy of a 7% yearly return. And then Intel recently cut their dividend, and the market liked it. They've gone up quite a bit, but I've sold some good cover calls on it. At the time, it was selling at 28, and I picked up $258. The call itself was at 32.50. It was just shy of a 24 Delta. So I did well with that one too. And since they're paying, I think they're paying like a 2% dividend again. They were at a 5%, and brought in a little more than $250, $253.40. So not bad. Next was WBD. This is Warner Brothers. This is kind of a unique trade. I don't really want to own them. So it was a spinoff from AT&T. So I've been selling these in the money calls at $12.50. It's currently $14.50. This was a roll. I rolled it from $4.21 to $7.21 and brought in $79. Now, this is the second time I've rolled, I think the third trade. So I brought in $300 on it. And it's funny, it has not gotten assigned. I actually wanted it to get assigned. When I first did first time I did the trade, it was trading right around $12.50. So it has recovered a little bit, but it's not making money. It doesn't pay a dividend. Again, it's not something I want to own. XLE, we're getting into vertical put credit spreads. XLE, which is another ETF I really like. It's the energy-based sector ETF. And I rolled it from 80.70 to 79.69. Rolled it from 331 to 616, so about a 3-month roll. And I brought in, 180.80. And it's 42% return, so did quite well with that one too. Here's Schwab. I rolled it. This is actually the second trade I did. Well, not the second, third trader. So I've done with Schwab. I've been selling a lot of puts on Schwab. So, and this was around the time I believe the market took the dive, or the banking sector took the dive. So I rolled it 72.50, 62.50. I was able to roll it down to 70.60, brought in another 172, and that trade was a 46% return. So did fairly well with that. Zoom's been really has done nicely for me. This was a new vertical put credit spread, 55.45, 16 Delta. At the time, it was at 69, so pretty far outside the money and still earning pretty good premium. It was 2 contracts, 297, and 68% return. Again, Zoom is a great company. I've done really well with selling puts on them. XLE, again, another new trade with XLE. I believe this is in maybe one of my retirement accounts, but lower, 66.56. XLE, I believe, has come back above 80. So this was, again, 17 Delta, expiring 5/19. So it didn't go too far out, and it's one of my more profitable, 65% yearly return. And then Schwab again, rolled it. Another one. This is probably, I had started, and you'll see at the very bottom. So this is the one I did after the banks had the huge drop. I think Schwab dropped by 30%, maybe as much as 40%. This was a 22 Delta, took a little bit more risk. At the time, it was at 53.89. I believe it's still right around that. Of course, it may have come up today. I haven't looked at the market today. And I rolled it from expiring 4.6 out to 5.19, kept the 2 strikes the same, brought in 176. This was a 68% return. And you'll see at the very end of this that the first trade when I first got into it after the banking crisis first hit was probably my best trade. Here's Truist. This is probably, well, this is my third best trade. Another new trade, 25, 1750. What's interesting is I couldn't go any lower. 1750 was the lowest strike you could actually purchase a put on. And it's a 22 delta, again, a smaller spread, only going out 2 months or 3 months. 259 and 84% return, or 81%. And then finally, Polaris did that just recently, a new vertical put credit spread, 95.85, currently trading at 106, a 19 delta, brought in 247, didn't go as far out, 519, so like 2 months, less than 2 months. And it's a 99% return, so it did quite well with that one. And then Schwab, here's the one that I was talking about earlier. This is the one I made right after the banking crisis, a new 55.45. At the time, it was at 62, and again, it's come down quite a bit since then, a 22 delta. It was only a three-week expiration, made 231, and the return was so high because of it was only for 3 weeks. So those are the trades. What's interesting, there were 20 total. They had a 0.24 delta. The covered calls had a 27 delta. There were 12 of them. Vertical put credit spread, 17 delta, almost 18 delta. There were 8 of those. No cash secured puts, all vertical put credit spreads. 10 new trades, 10 rolled trades. Total was $44.90.85. Average was $224 a trade. 20 trades total. So it worked out, quite well. Having a nice balance between calls and puts has worked out well during this bear market. So those are my trades. I hope you found this interesting. If you have any questions, please leave a comment below. And thanks for joining me, and have a great day.